In 1971, I worked as a clerk on the floor of the New York Stock Exchange. On August 15th of that year, President Richard Nixon appeared on television on a Sunday night to announce a seismic shift in the monetary system. He declared that the U.S. would no longer honor the fixed exchange rate that allowed paper money to be redeemed for gold, which was widely regarded as real money at the time. Paper currency, in contrast, was seen as akin to checks in a checkbook, lacking intrinsic value. Nixon offered some vague rationale for this decision, but the truth was simpler. The U.S. didn't have enough gold reserves to back the outstanding claims on its currency. When I walked onto the exchange floor the next day, I braced for chaos, expecting a catastrophic market crash. To my shock, the market surged, posting one of its biggest single-day gains in years. I was baffled and couldn't make sense of it. This experience drove me to dig deeper. Through research, I discovered a parallel event on March 15, 1933, when President Franklin Roosevelt made a similar announcement over the radio for the same reason: a shortage of gold to support the currency. Intrigued, I studied why the market rallied in both cases. I learned that when a government devalues its currency and loosens monetary policy by making money and credit more accessible, asset prices, like stocks, tend to rise. This realization reshaped my understanding of markets and taught me a critical lesson. Events that surprise us often stem from historical patterns that haven't occurred in our lifetimes but have clear precedents in the past. This insight led me to study the Great Depression and other major historical events. That groundwork proved invaluable in 2008 when I anticipated the global financial crisis. I recognized that when a debt crisis pushes interest rates to zero, rendering rate cuts ineffective, governments resort to printing money and purchasing bonds to stimulate the economy. This is exactly what happened in 2008, mirroring the dynamics of 1933. Had I not studied those earlier events, I wouldn't have foreseen the crisis. This experience fundamentally changed my approach to decision-making, prompting me to explore patterns that transcend my lifetime. It's why I recently wrote Principles for Dealing with the Changing World Order, emphasizing the need to study historical cycles to understand events unfolding today, events that echo the 1930s or other pivotal eras. One such issue is the looming debt crisis, which I believe we're approaching. Most people, including economists and policymakers, don't fully grasp the dynamics of the long-term debt cycle. They're familiar with short-term cycles. When the economy weakens, inflation drops, and central banks ease credit, boosting asset prices like stocks. But when inflation rises, they tighten policy to cool things down. The long-term debt cycle, however, operates differently and is less understood, yet we're on the cusp of a critical juncture. Three key factors drive the long-term debt cycle. First, people often assume rising interest rates are solely tied to inflation or monetary policy tightening, but they overlook the limits of debt growth. Debt, at its core, is a claim on future money. One person's debt is another's financial asset, like a bond. When bonds make up a significant portion of portfolios, they represent a massive pile of debt. Think of the credit system as the economy's circulatory system, delivering buying power to all its parts. If that buying power fuels productivity, it generates incomes sufficient to service the debt, creating a healthy cycle where everyone benefits. But if debt grows faster than the income needed to repay it, the system becomes strained. It's like plaque clogging arteries, reducing room for spending.
For instance, the U.S. government now faces a $1 trillion annual interest bill. Without that burden, it could allocate $1 trillion more to spending. Over time, this problem worsens. Additionally, governments must refinance existing debt, $9 trillion in the U.S. this year alone, while issuing new debt to cover budget deficits, projected at 7 to 12% of GDP. This flood of bonds must be absorbed by buyers like individuals, institutions, central banks, or sovereign wealth funds. But these buyers are already holding massive quantities of bonds, and convincing them to buy more is increasingly difficult. The situation could deteriorate further if buyers refuse to purchase due to concerns like sanctions or oversupply. For example, in the 1930s, Japanese assets were frozen, leaving bondholders empty-handed. Today, similar risks, like sanctions on countries like China, could deter buyers, exacerbating the imbalance between bond supply and demand. When this imbalance emerges, central banks step in, printing money to buy bonds. This process erodes the value of money, as seen in 2008 and again in 2020-2021. During the pandemic, the U.S. government distributed roughly twice the amount of money lost by individuals and businesses, flooding the economy with cash. In 2021, this continued even without the same urgency, driven by policies like universal basic income. The central bank facilitated this by printing money, leading to a surge in prices that caught many by surprise. This was a warning sign, a palpitation akin to a minor heart attack, signaling a deeper issue in the economic system. The long-term debt cycle is like cholesterol buildup in the body. The absence of a full-blown crisis can lull people into complacency, but the warning signs are clear. We're nearing a point where debt service requires borrowing more money, and bondholders may grow wary of the risks. In private markets, this is called a debt-death spiral. Rising credit spreads increase borrowing costs, which further strain debt servicing, creating a vicious cycle. My analysis suggests we're close to this tipping point. When private buyers can no longer absorb the supply of bonds, central banks intervene, printing money to fill the gap. This devalues the currency, much like in 2020. You'll see interest rates spike even as the Federal Reserve eases policy, and the value of money will decline relative to gold or other assets. Gold, Bitcoin, or other limited supply assets may become alternative stores of wealth as traditional currencies lose purchasing power. In the 1970s and similarly in the 1930s, all major currencies depreciated together against gold. Today, no major currency, dollar, euro, yen, or yuan, stands out as a safe haven. Each faces its own debt and monetization challenges, making this an ugly contest among currencies. Money serves two purposes: a medium of exchange and a store of wealth. Even in hyperinflationary cases like Weimar Germany or recent Argentina, money retains its role as a medium of exchange. You can still use it, even if it's weighed rather than counted, but as a store of wealth, it fails, driving people to seek alternatives like gold or Bitcoin. Gold, historically the third largest reserve asset after the dollar and euro, is limited in supply and trusted by central banks. Bitcoin, too, shares some of these qualities, though its role is less certain. Real estate, while valuable, is less viable. It's immobile, interest rate sensitive, and easily taxed, making it a poor substitute for liquid, tradable assets. Given the uncertainty of the future, diversification is critical. A prudent portfolio might include 10 to 15% in gold to hedge against a debt crisis, as it tends to perform well when bonds and other assets falter. Investors often chase recent high performers like AI stocks, only to find they become overpriced. The best company isn't always the best investment, just as the best horse isn't always the best bet in a race if the odds don't justify it. Markets price in expectations, so balancing a portfolio to reduce risk without sacrificing returns is key. A well-managed debt crisis, or beautiful deleveraging, balances contractionary measures like tax hikes or spending cuts with stimulative ones, like monetary easing. This lowers the debt-to-income ratio while mitigating economic damage. However, the long-term debt cycle, which unfolds over decades, is less understood because it occurs roughly once in a lifetime. We're now grappling with a system where one person's debt is another's asset, and the unsustainable buildup of debt signals an impending crisis. By studying history, 1933, 1971, 2008, we can anticipate these dynamics and prepare for what lies ahead.